Alrighty, so this is the 18th video of the Maybe series and the 11th under enterprise value and equity value. And in this video, we're going to be talking about why enterprise value is not fully capital structure neutral in real life, right? So let's look at an example, right? Let's say that there are two companies. And let's say that company A is 100% equity and company B is 50% equity and 50% debt, right? Let's say that they are identical in every other way, right? So let's say that these are two companies with the exact same financial metrics, right? But one is 100% equity and one is 50% equity and 50% debt, right? Which one would you be willing to pay more for? Intuitively, it kind of sounds like you would rather have company A. You just get 100% of the equity. You don't have to deal with company B, which could possibly be in a bad situation because it's financed by 50% debt, right? And that's how real companies work as well. Because at the end of the day, when debt increases by a lot, right, this in turn increases the risk of bankruptcy, right? So this means that a really high debt company is more risky, right? And we know that a company is more risky, then what are we going to demand? We're going to demand a higher return, right? And we can't generate a higher return in company B versus company A because they're the exact same company. So we can't get more cash out of it, right? But what can we do in order to get a higher return? We can pay less for company B, right? So in reality, after your debt becomes a large portion of the company, as this debt amount increases, even though technically, yeah, they should be the exact same enterprise value, these two companies, in reality, because the higher the debt amount, especially once it gets above a certain point, there is an increased risk of bankruptcy that makes the company more risky. And if the company is more risky, you're going to want to have a higher return on that company, right? Because risk goes hand in hand with return. So you're not able to generate more cash from this company because it's the exact same as company A. So you're going to be willing to pay less for company B, right? So honestly, that's the amount of depth that I think that you need for coffee chats and interviews. There are some kind of nuances with it in the sense that a little bit of debt is good because it allows you to fully allocate capital better. It also gives you a bit of a tax shield in terms of your net income, as we've seen on the income statement. But honestly, I would stay away from all of that. I would simply say that once debt becomes exorbitant, then that increases our risk of bankruptcy, that therefore requires us to demand a higher return from it. And the only way that we can do that if they're financially identical is to pay less for that company. So that's how I'd answer why enterprise value is not fully capital structure, is not fully neutral to capital structure in real life. All right, so I hope that's been helpful, and we'll hop into the next video.